Good afternoon, everybody, and thank you for assisting to this webinar presented by SSQ Insurance. My name is Matthew Roy, Investment Fund Analyst here at SSQ. We are pleased to welcome today Julien Palardy, Vice President and Director at TD Asset Management, here to talk to us about their low volatility strategies that are present in the new Smart Beta portfolio. Please note that if there is enough time at the end, it'll be our pleasure to answer one or two questions that you can ask via the WebEx interface. You can also communicate with your SSQ insurance representative for all other questions. So without further ado, Julien, the floor is yours.
Thank you. So, today I'm going to be talking about the low volatility strategies. I'm also going to be saying a few words about the quant team itself, and maybe before even diving into the core of the topic, maybe I could say a few words about TDAM as a whole. So on page 2, what is TDAM exactly? Well, first of all, it's a subsidiary of TD Bank. We're actually the largest asset manager in Canada after the acquisition of Greystone that we did recently. Something that is probably less known is the fact that we have a very strong history in the institutional asset management space. So we're the largest pension fund money manager in Canada. And I remember when I joined TDAM 13 years ago, actually, that was really the core of our business. And most specifically in the quant group, all our assets were institutional. Well, now it's probably 50-50 roughly. Another interesting fact is that we're really involved in quite large range of asset classes, so both traditional asset classes, equities, fixed income, but also alternatives now. Now, we do dominate in some specific spaces, and the low-vol equity space is clearly one of those. So on the next page, on page 3, just to give a brief history of how this all started. So we started doing research on low-vol equities or on basic financial economic concepts in 2007, and I'm going to walk you through what we were looking at back then in a few minutes. But essentially what we saw made us think that we should definitely launch a strategy based on those concepts. And a couple of years later, we were launching the first low volatility fund in the Canadian market. It was the Canadian Low Vol Fund for institutional investors, and more funds followed after that in the global space, ACWI, not only for institutional investors, but also mutual funds for retail investors. And all those assets grew to reach more than $20 billion as of today in terms of AUM. So it's a massive success story, and it reflects the demand for risk-driven strategies in the market. So as I mentioned, roughly half of our AUM is institutional, and the other half is mutual funds or retail assets. On the next page, on page 4, you have essentially what I call the family picture of the quant team. So all these people are my brothers and sisters, and you have Jean Masson, who's kind of the father of the team. So he actually hired me 13 years ago. We have 17 people, technically not only investment professionals. There's also Carlos Phillips, who's a client portfolio manager, so he's a client-facing individual. But let's say 16 core investment professionals who take care of the low-vol money on a day-to-day basis. In yellow, you essentially see the portfolio management team. And in green, you see the individuals who are more involved on the research side of the team. So these guys are essential in building all the models that we use to manage those low volatility portfolios. And then in blue, you have the data team, which is also extremely essential. So these guys are not just normal IT professionals. They're in fact an IT front office group that's really involved in managing the data and building code that we need to run our strategies on a day-to-day basis. So if these guys were not there, there's no way the PMs would be able to manage the low volatility fund. So it's a fairly large team. We're actually the largest quantitative team in Canada. So not only largest low vol team, but quantitative overall. And this size is actually quite important. So scale matters quite a bit in the quant space. So if we didn't have that scale, we wouldn't be able to hire the best talent and get the best technology. It's not only scale, in fact, it's also experience. So the fact that we've been operating in the quant space for roughly 20 years or maybe even more than 20 years, we've been able to accumulate a lot of data that we use in our quant strategy. So all of this is very useful. And ultimately, by being the largest group in Canada, we can offer what we think are the best products out there. Now, diving into the low vol strategies themselves on page 5, why does volatility matter all that much? Some people think that volatility is not that important, most specifically if you invest over a very long horizon, but there's nothing further from the truth, actually. And a very good example of that is if we take an investment portfolio, and most specifically when it comes to incurring losses, if you imagine that the portfolio incurs a 5% loss, to fully recover from this loss, you would actually need to realize a 5.26% return. So 5% loss, but 5.26% return to recover fully, so to end up exactly where you were in the first place. So you need an additional 26 basis points in terms of positive return to offset your 5% losses. That's if you have a low amplitude loss. Now, if we push the example to something a bit more extreme, if you incurred a 50% loss on your portfolio, you would need to realize a 100% return to fully recover from this loss. So you need an additional 50% on top of your 50% loss to recover fully. So you can see how much of a massive gain you need to recover from this loss, and the larger the loss is, the more it's really an exponential relation between the loss incurred and the gain that you need to realize to recover from this loss. So overall, not only large amplitude losses are dangerous, but also the larger the amplitude of your overall returns, so the higher the volatility that you incur, the higher will need your average returns will need to be in order to achieve the same total wealth over your at the end of your investment horizon. And this is especially true if you have a long-term investment horizon. So the volatility is actually having an adverse impact on your total returns the longer your horizon is, and the more true it's going to be. So that's one of the reasons why volatility matters quite a bit when you invest for the long term. Now, on the next page, there's another thing about volatility that is quite special and that is worth mentioning. There's essentially a model that I learned when I was in school that's called the CAPM. So the CAPM is quite simple if we can summarize it in a couple of words. It tells us that the riskier an asset is, let's say a stock, the riskier a stock is, the higher should be its expected return, because investors will, being risk averse, they should be asking for compensation for taking that risk. Now, what we know in real life is that people are typically not always risk averse. There's plenty of people out there who are buying lottery tickets, who go to the casino, and not only they don't get paid to do that, but they're willing to give up their money to take that risk. So when it comes to the financial markets, what we observe in real life is not all that different. So the theory is essentially the black line, or the dark green line that we're seeing on the chart, and the reality is actually the dotted green line there. So when we look at the empirical evidence, what we observe in the stock market is that there's essentially no relationship at all between risk and return. So this entire financial theory that I learned in school, the guy who built that was Bill Sharp, and he actually won a Nobel Prize for this thing. So you can imagine what he would have won if his theory was actually working. So it seems like it's quite easy nowadays to get Nobel Prizes in economics, maybe a bit too easy. So essentially, so the model doesn't actually work when we look at the data. And this is what we were seeing in 2007. When we looked at the numbers, we were a bit shocked. Because we all learned this in school, and in fact, Jean Masson, who's running the group, was teaching that also because he used to be a professor. So he realized actually that there was nothing further from the truth. So if you don't believe me, on page 7, we see actual numbers, empirical numbers that back this. So this is in the global space, so developed markets only, over a 20-year period. And what we did to assess this, to verify the theory, was just to take all the stocks in the MSCI world, and we classified them according to their level of volatility into 5 quintile portfolios. So at the the extreme left, you have the lowest volatility stocks. So let's say most of the utilities or consumer staples would be in this quantile portfolio. And as we move towards the right, we increase the risk of the stocks until we reach all those tech stocks that are extremely volatile in the markets right now. So what we observe is that over this full 20 years of data, the least volatile stocks in the market actually outperform the most volatile stocks in the market. So not only there's no positive relationship between risk and return, but in fact it's inverted. And if we had looked at the numbers in the Canadian space or in the emerging market space or in the U.S., we would have seen exactly the same thing everywhere. So at best, the relationship is flat. At worst, it's really negative, like what we're seeing in the developed market space. I think the worst market is really the Canadian market, where the highest risk quantile portfolio actually incurred negative returns over this entire period. So this flies in the face of the entire theory that tells you that risk should be compensated within the equity space. Obviously, it's not. So another experiment that we did on the next page was to look at the behavior of those volatility quantile portfolios, so high volatility stocks versus low volatility stocks in different types of market conditions. So we looked at strong up markets, strong down markets, and finally normal market conditions that we see on the chart at the right. So what we observed is that essentially those higher risk stocks, even though they underperform in the long run, there's going to be short periods of time where they'll outperform the rest of the market and definitely outperform the lowest volatility stocks. That's going to be roughly 20% of the time, or let's call it one-fifth of the time, and that's going to be in strong up markets. Now, this will come at a significant cost. In strong down markets, those stocks will definitely underperform the rest of the market and the lowest volatility stocks. And finally, in normal market conditions, which are really most of the circumstances, there's no clear relationship between risk and return. So some people have this feeling that they can time the market. In the quant group, we don't really have the view that most people can time the market. So from that perspective, unless you have a strong certainty that we're going to be facing strong up markets over the next few months, then those higher risk stocks should probably not be your first pick when it comes to investing in the equity space. So when we looked at this, again, it was just evidence that was confirming the fact that low volatility investing really made sense. And we essentially decided to build a product around this. So on page 9, we can see the investment objective of the low volatility portfolios. And really back then, there were lots of managers. In fact, the vast majority of managers out there, their goal was just to beat the markets in terms of returns as much as possible over time. We decided to take a different approach at beating the markets. So instead of beating the markets in terms of returns, we decided to deliver, or to try to deliver, build a portfolio that delivered market-like returns over the long run, even though we saw the empirical evidence that was telling us that low-vol stocks actually outperformed the market. And since inception, we did outperform. But our goal was a bit more conservative than that. We just wanted to deliver market-like returns with much less volatility than the market. So our long-term goal in terms of volatility is actually 25% to 30% risk reduction compared to the market. And ultimately, the result of this is that you end up with a much higher risk-adjusted return. So you get paid a lot more per unit of risk that you take when you invest in equities. And just doing that actually makes for very attractive equity strategies. So instead of trying to beat the markets by 1 or 2% over time, which is quite difficult to achieve, we ended up taking a much easier approach to beating the markets by delivering better risk-adjusted returns, which is something that the vast majority of people should try to seek when they invest in the equity space. So this was the start of the low volatility strategies. Now, on the next page, how do we achieve this risk reduction exactly? So very early on when we decided to launch our strategies, we also decided to build our own risk models. And we did that for multiple reasons, but the most important reason was that we wanted models that were built around our strategies as opposed to being forced to build our strategies around commercial risk models. for Canadian investors, it's extremely important because the vast majority of commercial risk models out there are really built for U.S.-based investors, so they design everything from a U.S. dollar perspective, while our clients care about returns from a Canadian dollar perspective. So when you invest globally, it does matter. It matters a lot, in fact. So there are multiple features that we built into our risk models to make them the best possible risk models for low vol strategies. I'm not going to go into all those features because they're quite often there's lots of technical details around them, but maybe just to say a few words about correlations, for example. We don't look only into single stock volatilities. We also look at correlations between stocks, and there's actually a lot of correlations in the global space. For example, there's 1,500 names. This means more than 1 million pairwise correlations between the various stocks. And what you end up with when you just look at historical correlations are spurious correlations. So one stock can go up while another stock is going to go down, and it's going to make it look like those two stocks are negatively correlated over time, but actually it may be two very specific events that resulted in the two names going in different directions. So you need to treat those spurious correlations to get a full covariance matrix that makes more sense to build a proper low volatility portfolio. Now, one thing that is really important in the risk modeling that I mentioned was the fact that we design everything from a Canadian dollar perspective, and it results in a very different portfolio than if we design from a U.S. dollar perspective. But there's another feature that we implemented that was really important, and that is currency related, is how we deal with currency hedging and how it's reflected in the risk model. So we decided to hedge some currencies back to the Canadian dollar to deal with the risk attached to the Canadian dollar's volatility. And our hedging policy that tends to be revised maybe once per year or so is actually taken into account dynamically within our risk model. So if we were to change our currency hedging policy, our risk model would adapt to those changes as well to give always the most optimal portfolio that we can get given what we do at the portfolio level. So we're really the only ones in the global space to have such an approach when it comes to currency risk. So it's something that we're quite proud of, I would say. And this is like ultimately the team that we have, the guys who work on research, are essentially dedicated to improving those risk models over time. And we've been doing that for 10 years. So when it comes to results, on the next page, on page 11, you can see how things look like with our Emerald Low Volatility Global Equity Fund. And this is actually one of our fairly long track records in the low volatility space. And there's been multiple episodes where the strategy was really tested by the markets, and in all circumstances, it really actually outdid what we expected when it came to downside protection. So if we look at all the negative quarters for the markets, our low volatility strategies actually outperformed massively. So overall, since inception, we outperformed the market, but this is really because of those quarters of negative performance for the markets where we had a fraction of the downside. And in some circumstances, we were even flat, like Q3 of 2011, for example, the markets were down 10%, and we didn't lose anything on that quarter. So there's been a few cases like these where our downside capture was extremely low. There's been other circumstances like Q4 of last year where we had a bit more downside capture, but nevertheless, we provided very strong downside protection. And when it comes to up markets, our upside capture typically is much higher than our downside capture. So we have an illustration of that, something that we've seen over the last year, so the last 4 quarters on page 12. Here we have, first of all, since March of last year, we had 2 quarters that were slightly up, but not massively. So it's been fairly easy to keep up with the markets over that time period. Now in Q4 of last year, when the markets were down significantly, we had a 46% downside capture, which is still very strong downside protection. So it's a very low downside capture number. And when the markets rallied back, you would think that our upside capture would have been relatively low, but actually it was at 83%. So we had a lot more upside capture than our downside capture. And ultimately, this is what results in the low volatility strategies being able to not only match the market returns, but even outperform while delivering much less volatility than the market. So on a risk-adjusted basis, it makes for very attractive portfolios. Now on page 13, you can see the performance of the low volatility portfolio since inception. The global low volatility portfolio outperformed the market since we launched it. The U.S. one also outperformed the market, even though the markets have been fairly strong since we launched those strategies. The only slightly weaker strategy is the emerging market low volatility strategy, slightly underperformed the market, largely because of the strength of the Chinese market and most specifically the tech segment in the Chinese market. So these are high volatility stocks, and they did really well over that time period. So we slightly underperformed, but overall, on average, we did deliver market-like returns across our strategies. And finally, on the next page, you can see some interesting characteristics for our portfolios. The most important one by far is the volatility. So across our strategies, we delivered market-like returns, but with much less volatility than the market. As you can see here, all our volatility numbers are below those of the market. And this is in an environment where the volatility of the market, most specifically I'm thinking the global market, the volatility has been fairly low. So reducing risk compared to that is not always obvious. Currency hedging actually helped us in achieving this. But reducing risk in a low volatility environment is typically more difficult than in normal market conditions, and yet we achieved that. So ultimately, it gives Sharpe ratios that are very attractive compared to the market. The emerging market fund, because of its slight underperformance, is a bit more in line with the market, but the other ones are fairly above the market. So ultimately, you get a better risk-adjusted return or more compensation for each unit of risk that you take within the equity space. And there are some other interesting characteristics for the low vol portfolios. For example, dividend yield typically tends to be a bit above the market because of the nature of the stocks that we buy into the portfolio. So we tend to go towards slightly more, let's say, more conservative stocks that tend to pay dividends as opposed to not paying dividends. So we avoid those tech stocks that don't really pay dividends typically. And finally, price-earnings ratio, I would say, on average, pretty much in line with the market. Sometimes we're going to be a bit cheaper than the market. Sometimes it's going to be a bit more expensive. In the U.S. market, we do see that people pay a bit more for safety. So we do see that the low volatility stocks are a bit more expensive than the market, but we're not talking about bubble type of expensive. We're really far from being overpriced within each market that we invest in. So as long as those low volatility stocks remain low volatility and remain reasonably priced, they're going to remain attractive on a risk-adjusted basis as well. And finally, in terms of market cap, we tend to be, I'm not going to say small cap, but less large cap than the cap-weighted indices, so maybe somewhere in the mid-cap range. And that's largely because the cap-weighted indices are by construction biased in favor of large cap stocks, given the fact that they're capitalization weighted. So we tend to be a bit more agnostic to the size of the companies that we invest in. So on this, that's it for the content that I had to present. So I'm going to be happy to take any question you may have.
Okay, thank you, Julien. So we'll now proceed to answer some of your questions. First question, what is your policy with respect to currency hedging?
Okay, so I actually covered part of that. I can go more in details on currency hedging. So originally, when we launched the low vol strategies in the global space, we decided not to hedge because the Canadian dollar is a pro-cyclical currency, so it tends to be positively correlated with the markets. And when the Canadian dollar rallies, if all things equal, you would be losing money if you invest globally. And when it falls, you actually gain from the currency impact. Now, if the Canadian dollar is positively correlated with the markets, it means that typically the Canadian dollar is going to rally when the markets are up, and it's going to fall when the markets are down. So it actually reduces the volatility being Canadian investors reduces the volatility that we incur in the global markets. So hedging back to the Canadian dollar, the entire portfolio would actually be undoing this volatility reduction. So we didn't want to do that. But what we saw over the last couple of years was that actually the Canadian dollar was becoming increasingly volatile. So this positive correlation with the markets mattered less and less. And we decided to partially hedge some currencies back to the Canadian dollar. So we currently hedge the British pound and the euro entirely because of the geopolitical risk that we're seeing with those currencies. And we're also hedging the Australian dollar and New Zealand dollar back to the Canadian dollar because these currencies are actually more pro-cyclical than the Canadian dollar is. So this is the policy that we have right now. It varies depending on market conditions. So, for example, we were at some point considering adding even more currency hedging to the portfolio because of the low volatility in the equity space, while there was still high volatility in the currency space. But this kind of reversed last year with the increased volatility in the markets that we observed, more specifically in Q4. So we decided not to add back to those hedges last year, but we're continuously monitoring the situation. So it's really a strategic decision that is being made. It's not something that we would switch that we would change every week. But at least on an annual basis, we revisit the case for currency hedging, and if there are other currencies that we should be hedging, or if we should be reducing our hedges on some currencies as well. And as I mentioned previously, the fact that we built our risk model to take those currency hedging decisions into account dynamically is extremely useful to us.
Okay. And what would be the difference between your strategy and an ETF like BlackRock?
Yeah, so there's quite a few differences. So in the global space, the currency question is quite important. So the BlackRock that are actually replicating the MSCI MinVol indices, in the global space, they're all built from a U.S. dollar perspective. So even though you may see the performance in Canadian dollars, actually the portfolio is built to minimize risk for U.S.-based investors, not Canadian-based investors. So that's the first thing, and this actually matters a lot more than people think. The sector allocation and country allocation that you're going to end up with is going to be very different depending on your currency of a design when it comes to building a risk model. So that's one of the things, the hedging as well. So we do hedging to reduce risk. The ETFs are not going to be doing that, and certainly not dynamically. And on top of that, there are multiple things about the portfolio construction that makes our portfolios more dynamic than the ETFs. So one thing is the fact that we use outflows in and out of our portfolios to re-optimize dynamically the portfolio to reduce risk as much as possible all the time. The ETFs typically will do either quarterly or semi-annual rebalancings. And if in the meantime there's something that's going on in the markets, it's pretty much going to be ignored by the strategy. So that's one thing. In our case, we do at the very least a monthly rebalancing, and after that, on a daily basis, those cash flows are used to re-optimize the portfolio. So if something's going on in the market, the portfolios will react much faster than with ETFs. On top of that, the PMs have full discretion to intervene on specific market events. So if they feel like doing an additional rebalancing to reduce the risk of the portfolio further, given the market conditions, they will do it. If they feel like there are positions in the portfolio that they're not comfortable with because there could be a specific event that would hit a particular position, so let's say a scandal or fraud, then the portfolio managers will actively reduce or eliminate the exposure to those positions in question. Same thing for country exposures as well, or sector exposure, so we can vary the constraints that we have on countries and sectors to dynamically limit our risk or our exposure to those specific allocations, I would say. So the portfolio managers intervene a lot more in our strategies than in ETFs. And finally, in the case of the MSCI ETF or the iShares ETF, the constraints are all built from a relative perspective compared to the cap-weighted index. Well, in our case, we care about absolute risk, so all our constraints are from an absolute perspective. So that's also, in some market conditions, it makes quite a bit of a difference, I would say.
Okay, great. Well, thank you very, very much, Julien. Really interesting. So this will conclude the presentation. Thank you for your participation, and the next webinar will be at the end of August, so we hope to see you there. Thank you, everybody. Have a good day.
Thank you.